Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Well, today we're talking with someone who has a lot of expertise in global investing in the markets and around the world, and they are exceptionally interesting right now because of several opportunities. So I'm very excited to introduce Paul Boyne of Manulife to you. Paul is the lead portfolio manager of the Global Quality Value Strategy and team at Manulife Investment Management. Previously, he was with Invesco Perpetual and Bank of Ireland, where he served as Deputy Chief Investment Officer and Head of Global Equities. Paul began his career as Grant Thornton International. He is a fellow of the Association of Chartered Accountants and earned his degree at the Michael Smurfit Graduate School of Business, University College, Dublin. So, Paul, welcome to the podcast.
Thank you. Thanks
So,
for having me.
so, as I said, I'm glad to have you here at a very interesting time. Global investing is having a moment after some tough years. Why do you think global is important to look at now, and how?
Sure. So maybe just to step back for a second. When I began my career, it was in the early 90s, and Japan had just come off a long period where it got to roughly 50% of the MSCI EFI index. First decade or so of my career, Europe dominated. And obviously, of late, we've come off the best part of a decade of US dominance. Regionally, these things cycle. And I think most people would agree that there are obviously very high quality companies over here in the US added a lot of value, especially some in specific sectors like technology, which are rather unique to the US. But there are equally a lot of very good companies internationally. And
Mhm.
international multiples, as we know, trade a lot cheaper than the US peers. I could have made that argument for the last decade and it wouldn't have mattered. But I do think we're at a point now where there are some very specific catalysts that are causing people to reevaluate their asset allocation between domestic US and international. So this is not a sell US, buy international call, but rather increase diversification. And I think those catalysts include, but aren't limited to, things like US debt and the trade deficit issues, the tariffs, um, and they're being catalyzed by a political system which now seeks change, which
Right.
is Trump, Besant, Lutnick, and probably seeks change because some of the things that have been so beneficial to the US, I think they're questioning now whether the status quo still makes America safer and stronger and more prosperous, or are there things that require change? And those changes have knock-on effects internationally, which are creating international investment opportunities.
Well, so one of the things that is definitely happening is a massive amount of capital repatriation that's in process or planned. So, where do you think that will lead for investors in global markets?
Sure, and I think some of that is being encouraged by the administration. So to get the trade deficit down, we know that the balance of payments requires the capital flows to fall, well, for them to balance. So one way to get the trade deficit down is to get the capital flows into the US down and almost discouraging money flow into the US and encouraging money out of the US helps that deficit side. I think a weaker dollar also benefits the US. So again, I think the US is actually motivated by to encourage some of this capital flow internationally. I think there have been events over the last couple of years which have caused international parties, governments, etc., sovereign funds to question the security of some of their assets in the US. And I think as well that if I look at the Swiss National Bank, for example, we know the foreigners peaked in treasury purchases in 2014. The Swiss National Bank disclose their equity holdings, which are very much tech oriented, NASDAQ oriented, high growth oriented, areas that have made a lot of money. There, Trump has catalyzed Europe, for example, more than Europe's been able to in the last decade.
Yeah.
Obviously, herding 27 cats is difficult. And
Yeah.
now, finally united, the defense moving towards a higher defense spend with a 2035 aspirational goal, I guess, of 5% is an example where Europe is finally coming together. Mertz's German plans require fiscal spending. The Draghi plans require fiscal spending. So there are lots of reasons why Europe may be finally getting its act together, but it requires to spend money. And going back to my point on the Swiss bank, to spend money you need to realize money, and where is that money coming from? And a lot of that money may come from simply reallocating or repatriating money back from where it is, probably the US, probably in higher growth NASDAQ type stocks, back to places like Europe and also Asia, Japan as well.
Mhm. Yeah, I mean, there's an interesting trend in Asia. Also, it's there. This is exceptionally interesting, and just certainly something that is important to think about as an investor. So, or someone who's advising investors. So, part and parcel to this, there's been some populism around the world. It's not just the U.S. We've talked about it only in the context of the U.S., but there's been some populism trend around the world. So, how do you expect those things to work out for, once again, for investors, global investors, if that trend of populism and those ideals perpetuate for a while?
I think that populism could actually be a threat to global investing, both including the US. We know that, and the reason I say that is debt levels are very high globally.
Right, right,
So we talk a lot. I'm based here in the US, despite my accent. We know US debt gets a lot of attention. French debt is very high as well. Japan, people talk of the debt, you do have to separate between gross and net. If you get a situation where politicians cede policy to the wills of people who clearly do not want increased taxes, want, obviously, for often for very good reasons, support, they may not take the actions that are required to get the debt to GDPs down. I think political leadership is sometimes saying the unpalatable thing, and by leadership and persuasion, getting the people to go along with you. And we know debt to GDP has to fall. Not taking that action by ceding actions to populism may be a problem.
right. And
That grows interest rates.
yeah,
Maybe.
and I was thinking a little bit about you know, there's a variety of possibilities for how that might happen, but as you say, it's the will above all things, right? I noticed you didn't mention Canada's provincial debt in there. Is that was that intentional, or is it just you didn't get to it in your list?
No, I
Um,
just didn't get to it in my list. I mean, we could look at some state debts as well, like California. I think what's happened over the last 20 years is debt has slowly migrated itself up to the sovereign.
right, right,
Now, ultimately, people are responsible irrespective of the location.
right.
But it's gone to the sovereign. It really can't go any higher. And the question, therefore, is how is that problem dealt with? One advantage that international markets have over domestic US is that many countries are in a positive foreign investment position. The US is in a negative one. So foreign countries, including Europe, obviously is number one investor in the US, Japan, can sell assets in the US to bring them home to fund projects, repay debt. US is not in that position. Foreigners own more of the US than the US owns of international assets.
Right. And if I understood the rationale for several of the rating agencies' view of the US's economy, that was actually a benefit. They gave it some credit for the fact that dollars underpin so many contracts, and basically, in short, there's so many dollars sloshing around the earth that it provided a level of liquidity that wasn't even imagined before. So, I mean, do you share the same view of the value of that?
Yes, I think there's a couple of reasons why overseas countries essentially own dollars or hold dollars.
Mhm.
One is for defense reasons.
Right.
One is for simply for an investment,
Mhm.
buying treasuries, etc. And one is simply for trade. So if I'm Korea and I want to buy oil, I have to buy from France, say from Total, I have to translate into dollars first. So there's a medium of exchange requirement here. That is the exorbitant privilege, I guess, of the US reserve currency. And the US has been a beneficiary of overseas money essentially coming back into the US in terms of reinvestment in capital assets, etc., capital markets. I think that there's a question out there as to whether the US loses its reserve currency status. I think the answer to that is no, but I do think its role diminishes. And we're seeing moves, obviously by China for one, to reprice trading, for example, in local currency or in different forms of currencies. But again, I go back to my earlier comments and go, is that advantageous for the US or not? and retaining reserve currency status, but a diminished role, a weaker dollar, can actually be advantageous. If I want to reshore assets to the US, which for strategic national importance, it makes a lot of sense, ultimately I'll have excess capacity and exporting is better with a weak currency than a strong.
Okay. And, we do have a entire, sort of global economy that's structured around US hegemony, to some degree or another. But what sounds like what you're saying is more likely in the future is maybe sort of regional players. So, more than one. uh, how do you think that will play out for global investments?
Sure. I think that COVID essentially revealed some of the national strategic weakness that has occurred from outsourcing. It's most obvious in the US here in terms of if you can't make hammers and nails, how are you going to make, and like all good ideas, it probably just went to an extreme.
Mhm.
Suddenly, the national vulnerability became apparent. And therefore, we see the US is not going to reshore things like sneakers and t shirts, but they are reshoring semiconductors, which is, we'll probably agree, a security issue. And with that, there's a race for AI, so data centers, manufacturing things like turbines, things like transformers to get enough power into these things. There is a race on for all that. So that capacity has to be made at home. Equally, Europe has recognized the same thing. As I said, I think Trump has made Europe cohesive. The Draghi plan has talked about increasing European competitiveness rather, of their industries. Jamie Dimon only last week was quoted in the FT basically saying that this is now an existential question for Europe. If Europe wants to be a dominant or important rather region, it has to start investing in itself. The Draghi report talks about the areas of investment. Macron made a speech before Christmas of 24 talking about $300 billion of euro savings
Yeah.
flowing to the US every year, which is
Yeah.
crazy when Europe has its own investment needs. Europe is talking about savings and investment union to try to create a stronger capital market and debt market basis in Europe. So I think we are seeing some forms of regionalization in terms of regions solving that security issue. And as an investor, we can take advantage of that by being the beneficiary of what essentially is government encouraged. Look, rather than call it government allocated capital, but encouraged capital. Let's say
Okay.
the
Okay.
UK has talked about introducing a rule mandating a minimum percentage of investment in its UK companies by UK pension funds.
Right.
Europe, as I say, are talking about investing in certain industries, so is the US. We can take advantage of that by being on the recipient side of all that capital. And many of those companies that are now going to be supported have for the last decade been exactly the same companies, more than a decade, 20 years probably more, have been exactly the same companies that have been hurt by Chinese and Asian competition as work has been outsourced. So what I
Right.
think you could see is a change between the companies who benefited from capital flows, tech growth, into now essentially old world value type companies, utilities, industrials, etc., and a revisiting of the regions and where they operate. So again, why not now invest in a recipient of European capital if you know that Europe is bringing money home or feel that Europe is bringing money home or investing in those areas. And this opens up a new world of investment for companies internationally which trade at big discounts to the US for the reason because they've been suffering for so long.
Well, yeah, and this is exceptionally interesting topic to me because if you figure that the design, which had lived in the U.S. and in Europe for a while, and no other parts was basically design, and everything else was outsourced after that. If they start bringing manufacturing back in and keep the design, bring manufacturing back, that means a massive need for parts, specialist suppliers, like all kinds of stuff. How do you? It sounds a little bit like to me a very daunting due diligence problem from an investment perspective. Because as those companies begin to grow, you're not going to really know who's the whiz at managing them. There's a lot of issues here for due diligence. How do you see that?
So I definitely agree with the first part of that. This is, you don't just bring back a manufacturing plant. You reopen that, but then you have all the support services around it,
Mhm.
everything from parts and suppliers and transport companies, all the way to the guy selling sandwiches to the workers at lunch.
Right. Right. Right.
And in Europe, to be honest, leaving politics aside, it's no better than Build Back Better or Make America Great Again.
Hmm.
It's exactly the same plan for international markets.
Hmm.
We've seen the effect on industrial companies in the US or infrastructure companies in the US over the last couple of years.
Yeah.
So why would one not expect a similar impact in Europe? And you've seen some of that with some cement companies in Germany, for example. You've seen that with defense companies in Europe, where people are recognizing the flows, but it goes much more, it goes beyond that. You're also potentially can see consolidation across border in Europe going forward. So yes, it's complex and all jobs are difficult, but that's one of the difficulties of our job to try to work that out.
Right.
But in principle, you can kind of hopefully, if one is right, you see the trends and you try to just take advantage of that.
Okay. Now, one of the things we talked about in our prep for this is a little bit more theoretical, but I did want to get you to talk a little bit to the members who are listening to this podcast about this because part and parcel to all this, there is this rise in yield curve controls. And this has been sort of underscored lately because some of the European long getting a little squishy. so, so the just give us your perspective on what you think if yield curve controls start to happen in other places other than the places where they've happened more recently, Japan, those kinds of places. If they get spread a little bit out, what do you think the impact of that is?
It is a risk, and we can look to Japan, obviously, from the 90s, late 80s,
Mhm.
to kind of witness what's happened there. So, first of all, why would you have yield curve control? Essentially, it goes back to the debt issue. It seems to me that countries are, you got two ways, a couple of ways, I guess, to get out of this debt to GDP. One is through austerity, which has been probably put aside at this point. The other way is to grow. So the focus is on growth. Whether we can get to the levels of growth required to get out of this is a question. Inflation will erode the real value of debt, but then you need to keep the interest rate
Right.
suppressed because
Right.
as inflation rises, you'd expect the long end of bond market will go up, yields will go up rather for fear of that. So hence you suppress interest rates, you allow inflation to rise, and you get the nominal growth and the erosion of debt on a real basis. The other thing I'd throw into that conversation is that we're seeing trade wars, which goes to this reshoring essentially.
Yep.
But trade wars to a point are also capital wars. And if, for example, we saw repatriation of capital from treasury markets that would drive up yields in the US, can the US live with market imposed yields? And would we have that situation? It would be yield curve control in most countries. It would be probably bad for the banks, be good for real assets. So going
Right.
back to a value type world, again, a world that suffered for the last decade plus, things like basic materials, obviously gold would benefit in that type of scenario as well. Real assets over paper assets.
Is there anything else we could learn from the experience that Japan had with attempting this in the early 90s and living with some of the benefits and some of the risks to it?
I'm just thinking about the market performance, and the lesson there was not to be invested in Japan, essentially. um, and no, to that point, the US as a percentage of the MSCI world has probably gone to somewhere over 70%.
Yeah.
US is
Yeah.
like 4% of the world's population. I think it's about, I could be wrong, I think it's about a quarter of the world's GDP, yet it's 70% of the global market cap.
Right. Right.
And I'm not saying that the US will go to zero because it wouldn't, but would it revert? When I started my career, I think the US was in the mid 40s, 50% of the world index.
Okay.
We're now in the high 70s, which means every incremental dollar requires 70% of it to flow to the US.
Right.
I'm hopefully painting a picture where at least there's an argument as to why that percentage seems too high. And again, I think that's an argument if you saw yield curve control in the US to be invested overseas. and vice versa, and just to be fair, you then probably get into a world of capital controls as well.
Right. Right. Yeah.
And
This.
that is not good for anybody.
Right. I hate to leave it on that kind of note, but but I guess one of the things I am exceptionally curious about now is going back to this due diligence topic. Do you think there are and also looking for good values around the world? It strikes me that there have been a larger number of better values out in the world because which you said at the beginning, there's not a lot of capital flowing to some exceptionally good companies. There's an awful lot of capital flowing to a very small number of companies. Fair? Is that
I agree with that.
okay? So, how do you suggest to the people who are maybe the CFA charter holders who are listening to this podcast, who have some level of responsibility to their clients, where do they start?
Sure. I think it goes back to like the word I used towards the beginning, which was diversification, as it's probably mainly a US audience. For a US audience that has a lot of assets, probably based in the US, probably based in high tech growth oriented NASDAQ type stocks. At what point does one consider diversification into other regions that have outperformed the US in the past over a multi year period? Into other areas which are more value oriented and growth oriented that we've talked about, utilities, basic materials, industrials, that there's a thematic behind, or hopefully, I believe there is, so hopefully that comes true in all regions. And one can take advantage of that by simply taking profits where one's made it and diversifying the asset base. If we are in a world of higher interest rates relative to the last 15 years, 20 years, not yield curve control, but just structurally higher rates, i.e. money's
Mm.
not free anymore.
Right.
The present value of long duration cash flows for growth stocks should be lower. And therefore, again, you're talking about something that would benefit a value world. So my argument would be think about diversification, taking profits, looking at other regions, and looking at other investment styles. And the other thing I'd throw in, as I mentioned as well, was for a US based investor, a weaker dollar that will augment the value of overseas investments. So retaining US investments, obviously within a global context, but having that exposure overseas too, and benefiting from that translation back into a US dollar based currency.
Yeah. Well, that is, as this is the house that was built by Ben Graham, that is a value play that we can leave CFA Study New York podcast on. So thank you very much, Paul, for being here.
Thanks, Rob. Cheers.
And thanks to everyone who is listening to this podcast. I hope that the things here were exceptionally interesting. You can find Paul and the other research by just Googling Manulife Investment Management. They have some great stuff on their website. Recommend everyone do that. Until next time, I'm Rob Rowan, and this has been Compound Insights.